your bank could flag you, even if you did nothing wrong, and it all comes down to one number: $10,000. Now, before you brush that off, because you've heard that number before, you need to understand something. This isn't about a new rule, it's about a new system. And that system is changing how your money is being seen right now. Imagine this. You wake up in the morning, pour yourself a cup of coffee, sit down in your usual spot, and check your bank account. Everything looks exactly the same. Your balance is there. Your deposits went through. Nothing feels off. But behind the scenes, something has already changed, quietly, without any notification, without any warning. And most people, especially seniors, don't realize it until it's too late. I'm Rasmus, and this is Rule by Seniors, and today I'm going to show you something that most people are only going to understand after it becomes a problem. We're going to break down what this $10,000 rule really means heading into 2026, why it suddenly feels more risky, and the one simple mistake that can trigger everything, even if you've followed the rules your entire life. And I want you to pay close attention, because there's one part of this that almost nobody talks about. And it's the reason completely normal people are getting pulled into situations they never expected. Let me show you how this actually plays out, because this isn't theory. This is real. Meet Patricia. She's 71 years old, a retired school teacher. For over 3 decades, she did everything right. She showed up every day, saved consistently, paid her taxes, built a life based on stability and discipline. Now her life is quiet, predictable, the kind of life most people hope to have in retirement. Every morning she follows the same routine: coffee, kitchen table, phone in hand. She checks her bank account. Not because she's worried, but because that's what she's always done. Her Social Security check comes in every month. Every now and then she transfers money from her savings. Sometimes it's for something small. Sometimes it's for something bigger: a medical bill, fixing something around the house, a visit to see her grandchildren. Nothing unusual, nothing risky, just life. But here's where things start to shift, because the system doesn't see Patricia. It doesn't see her history. It doesn't see her discipline. It doesn't see the decades she spent doing everything the right way. It sees data, deposits, transfers, timing, amounts. And if those patterns don't line up perfectly, it starts asking questions, not because something is wrong, but because something doesn't match, and that is where people get caught off guard. Now, to understand why this is happening, we need to go back all the way to 1970, because that's where this story really begins. Back then, the U.S. government passed something called the Bank Secrecy Act. The goal was simple: give authorities a way to track serious financial crimes, money laundering, drug trafficking, tax evasion. And one of the key rules they introduced was this: any cash transaction over $10,000 had to be reported by banks. That report is called a currency transaction report. And for decades, that number never changed. Now here's the part most people don't realize. That $10,000 threshold was set over 50 years ago. Adjusted for inflation, that's roughly equivalent to around $80,000 today. Think about that. What used to be considered a large, unusual transaction is now something completely normal. Retirement withdrawals, home-related expenses, moving money between accounts. But the system never updated. The number stayed frozen in time. And as financial behavior evolved, more and more ordinary people started brushing up against that threshold without even realizing it. So now the question becomes, if the rule didn't change, why does it feel more dangerous now? And this is where most people get surprised, because the real change isn't the rule, it's the system behind it. And it starts with something called, so what exactly is structuring? On paper, it sounds simple. It's when someone breaks a large amount of money into smaller transactions to avoid triggering that $10,000 reporting threshold. For example, instead of depositing $15,000 all at once, they deposit $9,000 today, another $9,000 tomorrow. Each transaction looks normal. But together, it creates a pattern, and that pattern becomes a red flag. Now, in serious criminal cases, this makes sense. The system is designed to catch people trying to hide money. But here's where things start to break down. Because the system doesn't understand intent. It doesn't know why you made those deposits. It only sees the pattern. And this is where seniors, more than almost any other group, run into problems. Not because they're doing anything wrong, but because their behavior doesn't always match what the system expects. Many older Americans didn't grow up with digital banking. Some still prefer cash, some keep money at home, some deposit smaller amounts over time because that's how they've always managed their finances. It feels safe, it feels controlled, it feels familiar. But to an automated system, that same behavior can look almost identical to structuring. And that's the disconnect. What feels normal to you can look suspicious to a machine. Now, here's where things start to escalate because once a pattern is flagged, it doesn't just disappear. That information gets reported, stored, and in some cases, reviewed. And this is where most people don't realize what happens next. Because when a bank files a report, that data doesn't just sit in one place. It goes into a federal database managed by the Treasury Department. From there, agencies like the IRS can access it, analyze it, cross-reference it. Now, for years, this system had limitations. There was simply too much data and not enough technology to process it effectively, so most of it just sat there, unseen, unused. But that's no longer the case. Heading into 2026, the biggest change isn't the rule, it's the technology. The IRS now has more funding, more advanced systems, and significantly more powerful tools. What used to require human review can now be done automatically, in seconds. Patterns can be detected instantly. Transactions can be compared against your income, your tax filings, your financial history without anyone ever manually reviewing it first. And that changes everything, because now the system isn't just collecting information, it's interpreting it. It can ask questions like, does this person's bank activity match what they report on taxes? Do these deposits follow a pattern that looks unusual? Does this behavior resemble known risk activity? And if the answer isn't clear, it flags it. Quietly. In the background, without you ever knowing. Now, this is the part where most people underestimate what's happening, because they assume if something was wrong, someone would tell me. But that's not how this works. The system doesn't warn you, it observes you. And only when something stands out enough, does it move to the next step. Now let's talk about where people actually run into problems, because this is where everything becomes very real. These are everyday situations that millions of retirees experience. And yet, they're some of the most common triggers for attention. First, retirement distributions. You spent decades building your savings. Now you're using that money. That's exactly what it's there for. Maybe it's a required minimum distribution. Maybe it's a larger withdrawal for something important. Home repairs, medical bills, travel, completely normal. But here's the issue. If that withdrawal crosses certain thresholds, especially around or above $10,000, it gets reported. And if it doesn't clearly match what appears on your tax return, even temporarily, that can raise a question. Not because something is wrong, but because the system doesn't immediately understand it. Second, helping family. This is something many seniors take pride in, helping children, supporting grandchildren, being there during important life moments. But from the system's perspective, it doesn't see generosity, it sees movement. Large transfers, repeated transfers, irregular patterns, and if those movements aren't clearly documented, they can start to look unusual, especially when they happen close together. Third, major life events, selling a home, receiving an inheritance, downsizing, relocating. These moments often involve large amounts of money moving all at once. And while they're completely legitimate, they create spikes in financial activity. And spikes stand out. And fourth, something that flies under the radar for a lot of people. Cash-based habits, selling personal items, collecting rent, holding money for a family member and transferring it later. These situations often involve cash, multiple smaller transactions, irregular timing, and when those patterns start to form, they can resemble structuring, even when there's no bad intent at all. Now, here's where it becomes critical to understand what happens next. Because once something is flagged, it doesn't automatically mean there's a problem, but it does mean you're visible. And that visibility can lead to the next step. And that next step is usually contact. It might start with something simple, a letter, asking for clarification, straightforward, but still unsettling, especially if you weren't expecting it. In other cases, it can escalate, a deeper review, an audit, where your financial activity is examined more closely over time. And in more serious situations, particularly when patterns resemble structuring, things can move faster, accounts can be restricted, funds can be temporarily frozen, and in rare but very real cases, you may have to prove where your own money came from. And that's the part that catches people off guard. Because at that point, it's no longer just about understanding the rules, it's about responding to them. Under pressure. Now, before this starts to feel overwhelming, there's something very important you need to understand, because this changes everything. The vast majority of these reports lead to nothing. Millions of transactions are flagged every single year, and most of them are never reviewed by a human being. No letter, no audit, no follow-up, nothing. But here's the shift. The system is no longer about volume. It's about precision. It doesn't need to look at everything anymore. It just needs to find what stands out. And that's why the risk feels different, because it's becoming more targeted, more selective, more dependent on whether your financial activity makes sense at a glance. So the goal isn't to avoid the system. That's not realistic. The goal is simple. Make sure your financial activity is easy to understand immediately. And this is where everything shifts from fear to control. Because there are a few simple things that make a massive difference. First, documentation. If money moves, there should be a record. Not complicated, just clear. If you sell your home, keep the paperwork. If you receive inheritance, keep the documents. If you take a retirement distribution, keep the statements. If you give money to family, and write it down. Date, amount, reason. Because if a question ever comes up, the difference between a quick resolution and a long, stressful process is documentation. Second, alignment. Your financial activity should match your tax reporting. This is where a good tax professional becomes critical. They don't just file taxes. They make sure your financial story makes sense on paper. Third, transparency. And this is the one most people get wrong. Trying to stay under the radar by breaking transactions into smaller amounts. That feels safe. But it creates the exact pattern the system is designed to detect. That's the mistake. That's what triggers everything. Now, there's one more layer you need to understand, and it has nothing to do with the IRS directly, but it can still pull you into the same situation. Scams, right now, there are people specifically targeting seniors, telling them to move money in certain ways. Small amounts, quick transfers, unusual methods, and often they create urgency. They pressure, secrecy, and here's the hidden danger. Those exact instructions create patterns that look suspicious. So not only can you lose money, you can also trigger system alerts without realizing it. So here's a simple rule. If something feels rushed, secretive, or unusual, pause. Talk to someone you trust, because one conversation can prevent a situation that's very difficult to fix later. Now let's come back to Patricia, because her story doesn't end with confusion. Once she understood how the system works, she didn't change her lifestyle. She didn't stop using her money. She didn't live in fear. She simply made sure everything was clear, on paper, and that changed everything. Now, let me ask you something. Have you ever moved money, helped family, or handled cash without thinking about how it might look? Drop a comment below because you're not alone. And this is exactly why this matters. At the end of the day, this isn't about fear, it's about clarity. Yes. The system is evolving. Yes. It's more advanced than ever, but you are not powerless because once you understand how it works, you stop guessing, you stop worrying, and you start making informed decisions. You know what triggers attention, you know what creates confusion, and most importantly, you know how to avoid it. You've spent your life building what you have. You've earned the right to use it, enjoy it, and share it without unnecessary stress. And when your financial activity is clear, organized, and easy to understand, most of the risks we talked about fade into the background where they belong because in a system that's changing this fast, understanding it isn't optional anymore. It's protection. If this helped you, share it with someone who needs to hear it because a lot of people still don't know this is happening. And if you want more clear, practical, no nonsense insights like this, stay with Rule by Seniors because the more you understand the system, the more control you keep over your future.